Gary Wagner's back. We have a brand new chart this next.
Hello Chart This viewers, Gary Wagner here, and welcome to this edition of Chart This After the Show. We try to bring you the most up-to-date technical information as we possibly can. And to that end, after the show, we'll try to fill in some of the gaps that we might not have had time to talk about during the regular Chart This show. However, if this is the type of information and technical knowledge that you're yearning for, that you're searching for, I highly recommend that you sign up for the Gold Forecasts Daily Report, because in the Daily Report you will get the type of information you get with Chart This only on a daily basis. Hello Chart This viewers, and welcome to this edition of Chart This After the Show. We're recording today the 17th of November, Sunday, and it's approximately 4:15 in Honolulu, which means that Australia and Hong Kong have been actively trading. Market is currently trading at about $12.85, so it's off about $4 or $5. And on our Chart This insert, what we really tried to hone in on was the identification of pivot points within the market using candlesticks themselves. One of the questions that I have been asked is, if you also use the Japanese average, does one outweigh the other? And the quick and easy answer to that is that because the Japanese average charts are composed of averages, they will always lag behind the leading indicators that can be provided by candlestick analysis. However, that being said, realize that the bounce that I'm looking for, this upside bounce, is really going to be, I believe, nominal at best. We're looking at a 3-day chart. We showed the 3-day chart in terms of the doji itself, but here's my basic dilemma with any kind of a long play in the market currently. This upper level resistance line that we have been talking about over the last couple of months, the first failure at 1435 and the second failure, roughly at 1335, each time the market was able to sustain some kind of rally, it ran into pretty much a brick wall when it hit this upper level resistance. This happened again here. And what I believe we will probably see unfold, even if we get the bounce, because as I said, right now the market's trading off a little bit, is for this market to really come up to this line and then begin to trade lower. Because it's my current belief in terms of our Elliott wave count that we're probably in wave 5 of 5. That would be the intermediate count, and I'll show you what I mean by that. What I'm looking at with wave 5 is we had our failure, of course, here, ABC, our correction. We go into an impulse phase, but it fails as it hits the market at 1800, wave 1, wave 2, our long wave 3 down, wave 4, and as I said, I believe that we're currently in wave 5 of 5. Now, within this particular wave, I believe that we're probably in wave 3 of 5. And here's how I'm looking at that. I believe that wave 5 currently is composed of 1, 2, 3, we'll get a 4th, and then probably a 5th wave down. Now, as far as I'm concerned right now, this is the key that we need to watch. This is the Standard & Poor's, a weekly chart, long-term chart, really from 2009 up till the present. This market, with a couple of realistic dips, nothing too severe, has pretty much been on an accelerated path. We, of course, went to record highs as this market came above the top that we hit back in 2008, and we are at record highs right now. My sense is that as long as we're looking at a marketplace in which investors, institutional investors, money managers believe that they're going to get their best return in the equities markets, the money will, according to liquidity theory, move from where they're not getting great returns to where they are getting great returns. And the equities market is just that. Now, during last week, we have had a couple of attempts in which the marketplace itself tried to move back above 1300. If we do get some sort of continuation of the rally which began at 1260, that's right here. You can also see the sub count that I'm talking about, conclusion of 4, 1, 2, and as I said, I believe we are in 3 of 5 right now. A little clip up, I believe, could take us anywhere between 1310 and 1336 before moving back on its downward path. Now, the caveat, and the caveat is a good one because I am a gold bull in a bear market, is that at any point, the fundamentals shift and the perception shifts, you can move from a bear market into a bull market. That being said, January 15th is where the United States government has kicked the can, so to speak, down the road because they'll have to deal with the debt ceiling as well as the impending tremendous budget deficit that we have that keeps climbing. And so without actually tackling that, once we get into the beginning of 2014, I think you might see some real fireworks. Well, I hope that gave you a little bit of insight into the marketplace and a little bit more knowledge than you had coming in as you watch the show. And again, as I said, we do have a special offer. And the offer will allow you to look at the daily report for the next couple of months at a greatly reduced cost. This way, through the end of this year, beginning of next year, you can get the Gold Forecast Daily Report each and every day and see if it's right for you and if it allows you to be a more successful investor and trader. Have a great day. Bye-bye.